This episode is going to share 4 helpful tips that's going to guarantee you get approved for any credit card that you want.
You would always want to be on the side of having good credit.
You think it pays to have good credit. You ever apply for a credit card knowing you have excellent credit, 800 credit scores, 750 credit scores, and you still got denied for a credit card? It happened to me. This episode is going to go over 4 helpful things that you need to be aware of before you apply. Number 1, no recent credit cards or any sort of accounts added to your credit reports within 6 months. When you have new accounts added to your reports within a 6-month period, most credit card banks will look at that as you applied for something, you bought something, and now you need a credit card for extra money because all of your money went to buying something. So they're looking at you applying for this credit card in a way to reserve cash, or you need extra cash and you're at a high risk. Now, most people may say, well, Chris, wouldn't it be smart for the bank to give me their money or a credit card knowing that I may be in a tight spot because I just bought something? Now I can use this credit card and they're going to make interest. They see that I have great payment history on my credit. Why would they not give me this credit card knowing that they can charge 18, 20, 25% and I'm going to make the payments on time? That sounds smart, but it's still at a risk of being charged off. Today, I think we are in the most credit card debt and most credit card charge-off accounts that we have ever been in history. So banks are very, very strict these days when it comes to credit card applications. Number 2, no more than 3 hard inquiries within a 6-month period. I believe this is the dumbest thing ever. Honestly, adding hard inquiries to anyone's credit report, in my opinion, is just stupid. Why are we dinged whenever we apply for something? I think it's good for us as consumers to be alerted when someone runs our credit, but should that be on our credit reports? I don't think so. Maybe that's a topic for another episode, but I just think it's kind of hypocritical how they tell young adults to build credit so they can be approved for a house or a car. Yet if they go and apply for something to build their credit, the hard inquiry gets dinged against them. That doesn't make sense. If I open up a credit card, I'm dinged for applying for that credit card. I just purchased a home last year. I got dinged for applying for the mortgage loan, but the mortgage loan is going to eventually build my credit from the payment history. Like I said, that's a topic for another episode. I think it's stupid that we even have hard inquiries on our credit reports. Thank God it only reports for 2 years, but like I said, I don't think it should be on there at all. I say screw not having medical bills on your credit. I think hard inquiries should be the first thing that should no longer report to consumer credit reports. And like I said, I think it should be something that alert us and only that us as the consumer can see it. But as far as banks and lenders, I don't think that's fair for other people to see how many times I apply for something. But with that being said, getting back to the purpose of this episode, no more than 3 hard inquiries on your credit report within 6 months. And I know this for myself because I recently applied for a business credit card and I believe I have 5 hard inquiries within the last, I guess, 12 months. I purchased a home 5 months ago. I got a credit card. There was something else that I had to apply for my business. Oh yeah, when I relocated out here to the Phoenix, Arizona area, I actually had to run my credit to get our bond for our business. That's based on credit, believe it or not. And I have a few hard inquiries that's on my credit report just from the move. So there were multiple inquiries on my credit, nothing related to accounts or auto loans or anything crazy like that. It's just that they seen 3 hard inquiries and the credit card that I applied for instantly denied. It said it was going to send me a letter in the mail. Weirdly, it sent me something in the email. It was a PDF letter. I opened that and it said, your reason for being denied, too many inquiries within 6 months. And I'm like, wow. So I came to the conclusion that anytime you're over 3 hard inquiries within a 6-month window, that is going to usually put you in a so-called risky category, because banks look at that as you're applying for money, you're applying to borrow too many things. You may have opened up these accounts and they may have not reported to your credit yet. So that's why I say no more than 3 hard inquiries. Hopefully you don't have any hard inquiries within the last 6 months. But if you do, no more than 3. When you're above 3, things are going to kind of get somewhat iffy with these auto rejections when it comes to credit card applications. Number 3, this one matters the most. No more than 10% credit card utilization. Well, a lot of people get misunderstood about this. A lot of people think they are supposed to purposely leave 30% of the card's balance on their credit cards. That is not correct. And this is how that goes, or this is how this goes. So when you apply for something and banks see that you have unpaid credit card balances on your credit cards, banks will not consider you high risk unless you're above 30% utilization. That means you've ran up your credit card limit or your balances or whatever, and you're having trouble paying it off. It does not mean you need to keep it at 30%, because whatever balance that you're leaving on your credit card, you're paying interest on that. So that doesn't mean you need to purposely leave your credit cards at 30%. You're paying 20-something percent APR on 30% of your card's limit. That is stupid. The goal is to never pay interest on a credit card. That's how the banks make money off of you, which is why you use your credit card, and they only want you to make a minimum payment because they want you to feel like it's okay to leave a balance on your credit card, which is how they get paid. So the goal with this, when you have a credit card, you want to pay it off in full by the due date. That due date has nothing to do with credit reporting. That just states you paid your balance in full, and the bank cannot legally charge you interest on that account, okay? A $0 balance on the due date means $0 in interest. 0 times 0 equals 0. So the statement date, which is shortly after the due date. Some credit cards is 3 days after, some is 5, some is an entire week after the due date. The easiest way for you to find out is log into your online credit card banking account and download your latest statement. Whatever the last date of that billing cycle says, that is your statement closing date. So it should say something like February 1st, 2026 through February 28th. If it ends on the 28th, your credit card company reports the balance on the 28th to the credit bureaus. That's the balance that's reported. A lot of people, they pay their credit card off on the 15th when it's due, and they max it out the very next day. And 2 or 3 days later, when they go to report the current balance for that day, is maxed out again, and their credit score drops. And people are like, well, I just paid my card off in full. How am I at 90% utilization percentage? You know, that's because the balance is maxed out on the statement date. So what I do is I pay my card off in full by the due date. Legally, I'm not charged interest, and I do not touch it for that whole week. I just don't touch it for 3 or 4 days because I know that's my statement date. So I don't touch it for that period. And then once the statement closes and it's a new billing cycle, I go back to using it. When banks see that there's unpaid balances on those credit cards, you're going to be ranked as a high risk. Look at it this way. A credit card is literally the bank giving you money. They're giving you their money without asking for anything. They don't have anything as collateral. They don't have a house. They don't have a vehicle like an auto loan or a mortgage would have. They're literally just giving you their money on a plastic card, and you can spend it on or where, you know, whatever you wish, right? You can spend it anywhere or anywhere or anytime or anything, whatever I meant. So when a bank gives you their money, okay, they're going to judge you based on how high risk are you. If you have a lot of unpaid balances, you're considered a high risk. If you have lower balances or no balances at all, you're considered a low risk. So credit card utilization is a major factor in this. And lastly, number 4, this one is not nearly as important, but it's something to consider. And that is a mixture of credit. Banks like to see both revolving and installment payment history. What is revolving? Revolving accounts are credit card accounts, things that you use and pay it off in a 30-day window, just like a credit card. Installment accounts are accounts that you pay on a monthly basis. Auto loans, mortgage loans, personal loans, things that's due every single month and you pay it on time every single month. That is what an installment account is. If you only have one type of account, well, a bank is going to look at your credit report and say, his credit scores aren't really established, or his credit report or credit history isn't really established. Or if you have somebody who have years and years of on-time payments with both installment and revolving type of accounts, well, banks are going to look at this person and say, okay, they're experienced. Let's move forward. We don't see a risk. So if you follow all four of those things, you are guaranteed to get approved for whatever credit card that you need. Thanks for tuning in to this episode. If you wish to be a guest on our podcast, visit SturgisCreditRepair.com and click the podcast page to schedule an episode. If you need help with your credit, you can also sign up at SturgisCreditRepair.com and start your free trial today.
Sturgis Credit Repair. Sturgis Credit Repair. If you want a new house, call us. If you need